This isn't a risk-off bounce. This is a regime signal, and the rates tape is accidentally proving the metals bulls right. Because while the loud crowd keeps chanting, yields decide everything, gold just printed near 5,000 an ounce this week, silver ripped through the $100 line, and copper AS spreads literally screamed scarcity, right as the 10-year yield sat around 4. 24% into the end of the week, and the dollar index eased down near the high 97s. That combination isn't supposed to happen in the tidy little story people repeat on TV. And if you understand why it's happening, you'll know what matters next week, what level flips the whole setup, and what would actually break this move instead of just shaking weak hands out. Here's the trap most people fall into. They look at one variable, rates, as if it's a single dial. Up means metals down. Down means metals up. Easy, clean, comfortable. And wrong more often than anyone wants to admit. Because metals don't trade rates. Metals trade the mix, the composition, the credibility. They trade the real yield, the currency response, the curve shape, the positioning pressure, and the hidden plumbing that forces institutions to buy hedges when they least want to. And that's where the real pressure starts. If you only watched equities this week, you'd swear metals are just hiding from volatility. A defensive corner, a panic shelter. But the bond market is telling a different story. The 10-year wasn't collapsing. It was sitting up there in the mid-4s, yet gold climbed anyway into rare air, roughly $4,990 at the week, as high by many spot trackers. And silver didn't just follow. It tried to take the steering wheel, pushing above $100 and closing around $103 on the big day. At the same time, the dollar index finished the week around 97, 46, hardly a dollar wrecking ball. And copper, the growth metal, was trading around $5. 94 a pound on COMEX, while London spreads did that thing that makes physical traders sit up straight. A sudden backwardation spike where the nearby contract is more expensive than the next one, like the market is saying, no, not later, now. But that's not the part that matters. The part that matters is why those signals can align at the same time. And the hidden detail is this. It's not rates up or down. It's which part of the curve is moving, what that implies about real yields versus nominal yields, and what institutions are forced to do into a calendar window where liquidity thins and hedges get repriced. When the curve shifts in a certain way, front-end anchored, long-end wobbling term premium doing its own thing, you can get a world where nominal yields look high, but the market is still buying hard assets because the confidence in the path forward is what S actually deteriorating. That course, when gold stops behaving like a trade and starts behaving like an insurance contract, everyone suddenly remembers they don't have enough of. And if you think that sounds dramatic, good. It should. Because what's happening isn't a mood swing, it's math. Let's make it simple. Nominal yields are what you see printed on the screen. Real yields are what you feel after inflation. If nominal yields drift but inflation expectations shift, or if the market starts pricing the risk around the future rather than the present, the real yield backdrop can soften even when the nominal yield level looks intimidating. Meanwhile, the currency response matters more than the rate headline. A strong dollar can suffocate metals even if yields fall. A tired dollar can let metals breathe even if yields hold. And in late January, you're not trading a clean macro textbook. You're trading flows, hedges, month-end behavior, and the fact that an FOMC meeting is sitting right on the doorstep, January 27th at 28th, exactly when dealers, funds, and volatility controls tend to tighten their grip. Because if this one level breaks, the math changes. Now let's talk about the mainstream narrative, risk-off. In classic risk-off, the dollar rips higher, credit spreads widen, equities drop, and gold catches a safe haven bid. Sometimes that happens. But in classic risk-off, silver usually doesn't lead. Copper usually doesn't show signs of near-term tightness. And you don't typically see a backwardation flare in base metals while people are allegedly running from growth. That's why slapping risk off on this move is lazy. It's a label that avoids mechanism. Mechanism is where the truth is hiding. Start with gold near $5,000. You don't get there from retail coin buyers alone. You get there from an institutional shift, allocation, hedging, and a subtle admission that cash and duration isn't the only safety trade anymore. When gold climbs, while yields are still elevated, that's the market saying, I'm not buying gold because yields are low. I'm buying gold because I don't trust the outcome that yields are implying. It's a credibility premium, and that premium grows in two ways. One is macro, fiscal and policy uncertainty, geopolitical stress, and currency cross-currents. The other is structure, positioning and hedging pressure inside futures and options. That second one is where people get blindsided. Because the minute gold starts pushing into a big psychological zone like 5,000, the options market becomes a machine that can amplify moves. Not because of magic, because of hedging. If there's heavy call open interest above the market, calls that traders bought, calls that dealers sold, dealers often hedge by buying futures or spot as price rises to stay neutral. That's delta hedging. And when you get closer to a strike cluster, the hedging sensitivity can rise. That's gamma. In plain English, above certain levels, up moves can force more buying, which causes more up moves, which forces more buying. It's reflexivity. It doesn't guarantee a straight line, but it can explain why a market feels like it has a hidden motor when it should be tired. But that's only layer one. Layer two is positioning. When a narrative becomes consensus, rates high means gold can't go up, or silver's too wild to own, or copper can't stay strong if growth slows. It creates underownership. It creates skepticism. And skepticism is rocket fuel when price refuses to comply. Because skeptical positioning means there are people who need to chase, and there are shorts who need to cover, and there are risk managers who need to stop fighting the tape. Short covering mechanics are brutally simple. If you're short and price rises, your losses grow. Margin calls don't care about your thesis. Your broker doesn't accept, but the macro says, as payment, so shorts reduce risk, they buy back. That buying is forced demand. Forced demand is not gentle, it doesn't negotiate, and that's where the real pressure starts. Now add the calendar, late January is not neutral. You've got an FOMC decision on the 28th. You've got month-end rebalancing looming. You've got funds that need to report. You've got volatility measures that reset. You've got liquidity that can thin because people don't want to carry big risk into a binary event. When liquidity thins, moves get sharper. Stops get triggered easier. Gaps appear where you didn't think gaps could exist. That's how you get those "it makes no sense" candles that ruin both bulls and bears. So the why now is a stack. Fed week, month end, and a market that's already leaning the wrong way on the metals narrative. But that's still not the flip. The flip is the curve and the dollar together. When the dollar doesn't confirm the risk-off story, when it looks more like fatigue than dominance, metals get a tailwind. And when the curve's behavior hints that policy is boxed in, metals get a second tailwind. Because policy boxed in means the market starts thinking in terms of financial repression, debt management, and what happens if inflation doesn't behave. You don't have to believe in any extreme version of that story to trade the incentives. Policymakers prefer stability. Markets prefer clarity. When clarity fades, gold gets paid. Now let's move to silver, because silver is the loudest tell that this move isn't just fear. Silver crossing $100 is not normal. It's the kind of level that changes how people talk, how dealers hedge, how industrial buyers think about forward purchases, and how the entire small market dynamic can turn into a squeeze machine. Silver is thinner than gold. It doesn't take much flow to move it. And because it's both a monetary metal and an industrial metal, it can pick up bids from two directions at once. That dual identity is why it can look insane. It can also be why it leads at inflection points. Here, ask what asks underappreciated about silver at these levels. It is not just a price, it's a funding and inventory conversation. If silver spikes, fabricators and industrial users who rely on steady input costs can't just shrug and wait. Some will hedge, some will front-run purchases, some will delay demand. But in the near term, the reaction can be a dash for coverage, especially if availability feels uncertain or if delivery time matters. And when the market senses that, paper pricing can overshoot because everyone is trying to secure the same thing with the same tool, futures. But that's not the part that matters. The part that matters is what silver is telling you about the broader hard asset complex. The market is willing to pay up for convexity. It's willing to pay up for insurance that can run. That's not classic risk-off. That's a repricing of what protection looks like in this regime. Now bring copper into the conversation. Copper is supposed to be the truth serum for growth. And yet copper is behaving like a constrained asset. Not because the world is suddenly euphoric, but because supply chains done at T respond quickly, and inventories can become a problem faster than macro narratives can update. This week you saw one of those signals that physical traders respect. A spread spike in London where the near-term contract briefly traded around a $100 premium to the next day or S contract. That's backwardation at the front. In plain language, it's the market paying extra for immediate delivery. You don't get that from pure speculation. You get that when near-term availability is tight, when someone needs metal now, when warehouse stocks are low in the right location, or when a delivery constraint forces a scramble. And that's where the story links back to gold, because a world with physical strain in industrial metals is a world where inflation risks done T disappear just because growth headlines wobble. It's a world where the commodity complex can act like a pressure cooker. And when you have that pressure cooker plus policy uncertainty plus a currency that isn't T doing the classic safe haven surge, hard assets get repriced together. Now, let us talk about the paper versus physical tension without turning it into cartoon villain theater. You don't need a conspiracy, you need incentives. Paper markets, futures, swaps, options are built for liquidity and hedging. They're brilliant for price discovery until they're not. Physical markets are built for availability and logistics. When supply chains are stressed, physical premiums can rise. Delivery windows matter more. And the nearest price gets distorted by the urgent need for metal now. That tension often shows up first in spreads and term structure, not in the headline price. So when you see backwardation flare in a market like copper, or when you see metals holding up while rates are still elevated, the lesson is stop watching only the headline. Watch the plumbing. Because if the plumbing is stressed, price discovery becomes a negotiation between liquidity and necessity. And that negotiation is not gentle. Now let's put a few concrete numbers around the stage we're on, because this is where viewers either get anchored or get manipulated. Gold has been trading in the mid-4,000s to near $5,000 in January, with a high around $4,988 on the 23rd by several daily trackers. Silver started the month in the low 70s and then accelerated into the 90s before blasting through $100 with 103-ish prints on the big day. Copper has been hovering in the high 5s per pound with recent pricing around $5. 94 in a month range roughly mid-5. 70s to just over $6. 08, the 10-year yield around 4, 24% into Friday is not a start rates collapsed backdrop. The dollar index around 97, 46 into the close is not a dollar wrecking ball backdrop. That's the paradox. And paradox is where trades get born. But here's the danger. When trades get born, volatility gets weaponized. This is the psychological shield you need right now. Markets love to take a correct thesis and punish you anyway through timing. They'll spike up, force you to chase, then pull back just enough to make you feel stupid, then rip again without you. Or they'll pull back hard, trigger panic, and then recover the same day. The goal is not to be right. The goal is to survive the path. So separate trend signal from noise. Trend signal is structure, higher highs, higher lows, successful retests, spreads that stay firm, a dollar that fails to squeeze, and a curve that suggests policy isn't gaining freedom. Noise is the daily headline, the one-off candle, the talking head declaring it's over after a 2% pullback in a metal that can move 5% in a morning. Because if this one level breaks, the math changes. Let's talk levels and what they mean without pretending we can see the future. For gold, 5,000 is not just psychological. It's where positioning, option strikes, and risk committees start reacting differently. Above that zone, you can see acceleration because hedges get recalculated. Below that zone, you can see violent pullbacks because profit-taking and stop hunts become attractive. The first major "did the trend break?" zone is not a tiny dip. It's the area where buyers have already shown up. Think of prior breakout and retest territory around the high 4,700s to low 4,800s region, and then deeper structure around the mid 4,600s if volatility gets nasty. If gold loses those zones and stays lost, meaning it can't reclaim them on a bounce, that's when the regime story gets questioned. For silver, $100 is the battlefield. Above it, the market starts acting like it discovered fire. Below it, you can get those brutal flushes that look like the party ended, even if the trend is simply resetting. A controlled pullback that holds in the low 90s and then reclaims $100 is bullish structure. A violent break that slices through the 90s and can't recover is where you respect the possibility that the move was a blow-off. For copper, the spreads are the tell. If you see backwardation pulses and tightness signals persist while price holds above the mid-5s, that's strength. If spreads collapse, nearby premium disappears, and price rolls over through key supports, the constraint story weakens. But that's not the part that matters. The part that matters is what happens next week into the Fed meeting and month end. That's the why now window where the market either upgrades this move into a new normal or uses it to wipe out late chasers. Here's the two scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, metals cool off, the tape gets quieter for a moment, and the market tests whether real demand is underneath. Gold pulls back, maybe even sharply intraday, but buyers show up at prior breakout zones and the market stabilizes. Silver dips under $100, maybe to the 90s, but it doesn't collapse, it coils. Copper holds its ground and the worst of the spread stress eases without turning into weakness. The dollar stays heavy or range-bound rather than squeezing hard. The 10-year yield might wiggle, but it doesn't create a shock. This scenario is annoying. It's meant to bore you and scare you in alternating waves. But it's healthy if the thesis is right. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't give you the polite entry. It stays bid into the Fed, and any dip gets bought instantly. Gold pushes through 5,000 cleanly and starts acting like there's a vacuum above it. Silver holds above $100 and rips faces with 3% to 7% daily swings that feel unreal. Copper's tightness signals flare again and price tries to push toward the upper end of its recent range. This scenario comes with gap risk. It comes with you blinked and missed it moments. It also comes with the most emotional manipulation, because the higher it goes, the louder the chorus screaming top and bubble becomes, sometimes from people who were bearish $500 ago. And that's where the real pressure starts. Now, what confirms which scenario you're in? Watch the dollar response first, not the headline, the reaction. If the dollar starts squeezing aggressively, like it's reclaiming dominance, that can pressure metals short term even if the long-term thesis remains. If the dollar stays soft or choppy, that's oxygen for metals. Next, watch the curve tone and real yield feel. You don't need a PhD. You need to see whether the market is treating policy as credible and flexible or boxed and reactive. Boxed policy is bullish for the credibility premium trade. Then watch the spreads. In the commodity complex, spreads are the heartbeat. If spreads stay tight or backwardated, the market is telling you physical urgency is real. If spreads normalize rapidly and the nearby premium evaporates, that can signal the immediate stress is easing. Finally, watch price behavior around the obvious levels. Not because levels are magic, because levels are where decisions get forced. Funds, dealers, and risk managers anchor to those zones. Their behavior creates the very reactions people call technical. Well, now, let's talk counterpoints, because if you can't say what breaks your thesis, you don't have a thesis. You have a religion. A hawkish surprise that reignites dollar dominance can smack metals, especially silver, which is hypersensitive to liquidity. A sharp risk rally that pulls capital back into equities can temporarily reduce urgency for hedges. A positioning washout, where everyone suddenly piles into the same metal trade, can create a crowded door and a violent shakeout. And a sudden improvement in perceived supply, like significant deliveries into warehouses or easing in spot premiums, can cool the physical narrative in copper and, by extension, reduce the inflation pressure feel. Also, it is worth respecting the simplest truth. Metals can fall hard even when they row in a bull regime. Gold can drop 3% in a day and still be bullish. Silver can drop 10% in a day and still be bullish. Copper can whip around on China headlines and still be constrained. The path is not the thesis. The thesis is the destination logic. The path is a fight. Volatility will try to sell you two lies. First lie, if it pulled back, you were wrong. Second lie, if it's running, you must chase now or you'll miss your life. The both are designed to separate you from process. So here is the psychology shield in one sentence. Decide your levels and your horizon before the market decides your emotions for you. Because if this one level breaks, the math changes. Now, bring it back to the title. Rates shift, metals react, and the move isn't just risk off. It's a regime trade built on a credibility premium, amplified by market structure and timed by the calendar. The bond market is not merely high yields, it's a message about uncertainty. The dollar is not merely safe haven, it's a barometer for global stress and relative confidence. Metals are not merely fear. They're the scoreboard for trust. And the hidden detail, the thing mainstream coverage keeps missing, is that when curve dynamics, currency fatigue, and positioning pressure align, metals can rise even when yields look stubbornly elevated. Because it's not the level, it's the meaning. Now, what do you watch next week practically without turning your brain into a doom machine? You watch January 27th to 28 like a liquidity event, not a prophecy. You watch how price reacts into and out of the decision. You watch whether the first post-Fed move reverses, because the first move is often the trap. You watch whether gold can hold above its prior breakout zones if it dips. You watch whether silver treats $100 like a floor or ceiling. You watch whether copper spreads hint at continued urgency or rapid normalization. And you watch the dollar index behavior, because if the dollar can't capitalize on policy uncertainty, that's telling you something structural is shifting. And that's where the real pressure starts. Here's the clean takeaway that separates a serious viewer from a headline tourist. Stop asking, is it risk off? Start asking, what is the market forcing participants to do right now? Dealers hedging, shorts covering, funds rebalancing, industrial buyers front running, vol control reducing. These are actions. Actions move price, stories follow price. So if you're trying to be early, don't chase stories. Track the forces. One more thing, because this is where most people get played. The loudest voices will try to frame this as a morality play. Gold bugs versus economists, metalheads versus stock guys, conspiracy versus reality. Ignore that. The real divide is simpler. People who trade labels and people who trade mechanisms. If you're still here, you're in the second group. You want the plumbing, you want the scoreboard, you want the checklist. So here's your checklist for the next 1 to 2 weeks. Spoken like a market operator, not a cheerleader. If gold clears and holds the big psychological zone and dips get bought quickly, you will trigger in a continuation or squeeze environment. Respect the gap risk and Donati confuse pullbacks with failure. If gold rejects hard and loses key retest zones and can't reclaim them, the thesis weakens and you shift from trend to damage control. Iris, If silver holds above $100 and the dips are shallow, you're in a reflexive market. Expect violence both ways and manage size accordingly. If silver loses $100 and bleeds through the 90s without a fight, assume the market is resetting and stop treating every bounce as salvation. If copper's tightness signals persist, that supports the broader commodity pressure story. If spreads normalize fast and price loses support, the inflation pressure field can cool, even if gold remains bid for other reasons. And whatever happens, remember this. A correct macro view can still be a losing trade if you let volatility choose your entries and exits. The market doesn't pay you for being right. It pays you for being right while staying solvent and steady. Near the end of this, I'll leave you with a simple identity line because it matters. This community isn't here to worship metals or hate institutions. It's here to read the tape without getting emotionally outsourced. It's here to track the mechanism, respect the risk, and stay ahead of the narrative. Next week is going to try to steal your focus with noise. Don't let it. Watch the curve. Watch the dollar. Watch the spreads. Watch the levels. And when the market gives you a violent move that proves one side right, pause and ask the only question that matters. Who was forced to do what? Because the answer to that question is where the next move is hiding.